Hello, everyone. This is Rob McDougall from Zhang Financial here today with your weekly economic update. Today is Tuesday, January 16th, 2024. So, since the holidays have been continuing to transpire this year, not much economic activity. So last week, inflation heavy, so we'll talk about that. But that was really it. And this next coming week is pretty light in terms of economic calendar as well. So, last week, inflation was the focus. It is most weeks, but we did have some new data that came out, and it was mixed, very much mixed. On Thursday, the CPI came out in CPI Core, and CPI actually disappointed. So it was expected to come in for December at a positive 0.2, and it came in at a positive 0.3. Not good. Core CPI, as expected, came in at 0.3. The next day, however, the news was much better on the PPI front. PPI came in, it was expected to come in for December at a positive 0.1, actually came in at a negative 0.1, and then core PPI was expected to come in at positive 0.2 for December. That came in flat. So kind of a mixed picture there. The markets actually liked it. We'll take a look at equity markets and fixed income, both up in the U.S. for the week. So no real controversy there. So markets kind of liked it, but I would say that CPI number was definitely disappointing if you're expecting aggressive rate cuts from the Fed anytime soon. So in terms of expectations for the rate cuts, it did change a little bit. The expectation for the March meeting in terms of at least a 25 basis point cut, the odds a week ago were 61% odds of getting a 25 basis point cut. That moved up after the announcements on CPI and PPI last week, moved up to about 71%. Then when we take a look further out, we take a look at the end of this year and what the expectations are. There's now a 98% chance built into the Fed funds future that we'll get 100 basis points in cuts. And remember, and you've heard us say it plenty of times, Federal Reserve has communicated that we should expect 3 rate cuts or 0.75 for the year. Markets saying, no, we're definitely getting more, so 98% chance of 4 cuts, but there's also a 50% odd built into the Fed funds future market that will get at least 150 basis points or 6 cuts throughout 2024. In terms of expectations for the economy and the strength, just on fourth quarter, we always update you on the Atlanta Federal Reserve and their expectation, what the fourth quarter GDP grew. And remember, the third quarter was very strong at 4.9%. Atlanta Federal Reserve did revise their expectation for fourth quarter GDP down a little bit. So the prior week, they were at a positive 2.5%. Last week, they moved that down to 2.2%. Again, coming off that really fantastic number of 4.9% in the third quarter, 2.2% following that, I think would be really good. In terms of inflation expectations, again, after that, the numbers that we saw on CPI and PPI, expectations for the 10-year average of CPI moved up just a little bit, 5 basis points, but still is extremely low at 2.27% expectation for the average inflation over the next 10 years. So with the CPI, PPI numbers last week, equities were up slightly, fixed income up slightly. U.S. S&P 500 up 45 basis points, but that was not widespread and looked a lot like 2023 in that really all that benefited in U.S. equities, large cap and equity. So large cap outperformed small cap by almost 200 basis points. Growth outperformed value by about 170 basis points. Light week of trading, nothing big to read into it, but the trading did look a lot like 2023, not what we hoped for 2024. We had hoped for more breadth and the continued strength that we saw in the fourth quarter for both small cap and value. On the international front, up a little bit, but again, trailing the U.S. if you use the S&P 500 as the proxy. The MSCI World Developed Markets up 25 basis points. Emerging markets down 16, dragged down by, you guessed it, China down again, minus 30 basis points for last week. And remember last year, China down 13.3%, while you had the S&P 500 up over 26. So that pattern continues as well here in 2024. Fixed income, a little rally again last week. The 2-year yield was down 6 basis points. 10-year was down 2 basis points. So the U.S. Bloomberg U.S. Aggregate Bond Index was up 51 basis points last week. And last year finished very strong. Fourth quarter was fantastic. It was up 5.5% last year. So off to a good start in the bond market in the U.S. so far. So this week, in terms of economic data that's coming out, on Wednesday, we're going to have retail sales. We'll have retail sales ex-auto for December. Expectation for retail sales a little stronger than you might hope. In November, it was a positive 0.3. Expectation is that rose to a positive 0.4 in December. Retail sales ex-auto in November was positive 0.2. Expected to be the same for December. On Thursday, housing start building permits. These are expected to be way down from the November numbers. But if you recall, when we reviewed these a month ago, the November numbers were way above expectations and way above what we had in October. So kind of looks like November maybe was an aberration. So housing starts are expected to be down about 140,000 in December to 1.42 million. And building permits, likewise, is expected. Oh, actually, building permits, I misspoke. Building permits actually expected to be slightly up from the month of November. November was 1,460,000. Expectation is 1,478,000. So again, housing starts expected to be way down. Building permits up slightly from the month of November to December. Lastly, University of Michigan Consumer Sentiment Index. Sort of the same thing here in that we had a big spike for the month of December. So we had 4 consecutive months of downslope until December, then a big spike up in terms of University of Michigan's Consumer Sentiment Index. Expectation for the month of January is that it's going to be roughly flat, down a little bit. So the month of December came in at 69.7. It's expected to come in for January at 68.8. So that's it for the recap. Thank you very much for joining us. We hope to see you next week. Thank you.